Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about Srei Infrastructure Finance and whether it is worth it to invest into the company at around 3.5-4 rupees, or whether you should avoid it. So let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I start with the analysis of Srei Infrastructure, here's a small request that kindly support me on Patreon. And once you do that, it will help me grow the channel and also help you eke out answers from me. You can ask me questions about your stocks, your portfolios, etc. Also, there are exclusive videos as well as articles that I post from every week, 2 or 3 articles about stocks and stock calls and with stop losses and targets. Plus, once I have 100 Patreons, I'll start with a educational course on investment at YouTube for no extra cost. So kindly go there and support me there. Now about Srei Infrastructure. It was established in 1985 and they provide infrastructure equipment finance. So whenever there is a huge project that is being built by any marquee player, then they can take infrastructure equipment finance from this company. They also help in project advisory, investment banking and insurance. The market cap of the company has been reduced to around less than 1,000 crores, and it has filed for insolvency against two of its companies or clients. If you look at the financials of the company, this is Q3 FY20 versus FY19. The sales did increase. The sales dropped by around 11%, whereas the profit dropped by around 66%. It has extremely heavy debt of around 12-13 thousand crores, and there's heavy contingent liabilities. So you can say immediate liabilities are huge that Srei has to pay, and that's why the company itself went into insolvency recently, and the return on equity for the stock is around 11%, whereas the net profit margin is around 19%. But the problem is the profits and the sales figures have been dropping continuously over the last three and a half years. If you look at the performance of the stock, then the stock is falling relentlessly since July of 2017, and currently it has lost around 99% of its value, from being around something like 130-135 rupees. It is all the way down to only 3.5 rupees or so. The market cap has been reduced to 200 crores actually, so not 1200 crores, but the market cap has been reduced to only 200 crores. From at one time, the stock was having a market cap of around 7,000-8,000 crores. So you can understand where we were looking at when we looked at the company at its peak. It has become a penny stock now, so 3 rupees 4 rupees stock it is right now, and this is a clear example of what you should not be buying. So for instance, high debt company, I have always said that you need to avoid. Profits need to be increasing as the profits have been dropping, so that's another point. The third point I would like to make is that the company is into a sector like the infrastructure sector, which is completely avoidable, and these are not cash rich businesses, and these are highly capital intensive businesses, compared to which I like, which is a asset like model. And although there is high promoter holding, etc., but here you need to always churn out a lot of money to pay interest, so the interest cost is huge, whereas in a cash rich business there is virtually no interest cost, as there is no debt burden. So these are major reasons why I avoid some companies, and this falls into that category. And this is basically into infrastructure finance, and this will only do well when there is high risk environment in the business circle all across the globe, and these stocks will perform well when debt is reducing or interest rates are reducing, and government is pumping in a lot of money on the ground with respect to infrastructure expansion and so on and so forth, which I have not seen over the last in 8-9 years, so long as I have been in the markets. I think before that, till 2008, from 2003, there was a lot of infrastructure expansion with malls being built and so on and so forth. But today we are seeing the real estate prices at, you can say, rock bottom, and you have a lot of cases in which infrastructure has been built, but people are not ready to move in, or where people want some of the facilities or houses and housing societies, but they are not being built, and many projects are getting shut with a low liquidity or crunch of liquidity. So where liquidity is extremely less, you need to move away from high debt laden stocks such as, you can say, Srei Infra. So the reasons for decline, IL&FS default was the first one. So IL&FS has taken in a lot of companies, and Srei is not the one to be left out. And Srei Infra had given a lot of loans for IL&FS, and it just defaulted on everything and filed for bankruptcy. And what that led to was Srei Infra, in fact, saying that it was an NPA, and major portion of their loans went to IL and FS, and probably that has hurt the company very dearly. Management not meeting debt obligation was another reason, and with the kind of environment that we are in, I'm not blaming the management, because at the point of time when they took this debt of around 12-13 thousand crore, it was a totally different environment. And so currently, it seems like the management will not be able to pay the debt, and eventually these profits will turn into losses, and then even the company may even shut down. But I don't know about the details at the moment, but it looks like in the same manner, because the debt is around 12,000 crore, and really people are totally doubtful about the sector. So even better pure infra companies, pure real estate companies like Godrej Properties, etc., people are not looking at. So why would they look at something that finances such infrastructure? And we have seen many projects shut down. So really, financing of infrastructure is a complete no at the moment. Interest rates have remained firm even with this 0.75% cut. The interest rates is well over 4%, 4.5%, whereas global interest rates are, less than a percent on an average, around half a percent or so. And this probably the government, the RBI, has to look into, because if interest rates remain so firm, I don't think the expansion would work out that well. And current environment is absolutely detrimental for such businesses. So even if you are staying with such companies, I don't see any light at the end of the tunnel. Whenever the market turns around, it will be the consumer stocks that would do well. So what needs to be done? In my opinion, avoid at all cost and buy into low debt infra companies. So companies like NBCCs are much better than companies of this sort, even though NBCC has also fallen something like what is 80-85%, but it is a completely debt free company with projects from the government. I'm not saying that you go ahead and buy NBCC, but comparatively it's better. Comparatively, Godrej Property is better, Shobha Developers is better. But why get into such a sector when you are getting some of the best consumer companies at 30-40% discount? So that would be my understanding. Have a good 5-6 year view, but do not get into these infrastructure spaces. This sector is in trouble, and this will get into a deeper trouble after this crisis that we are facing, and have less than 5% exposure uh, to the stock. So this was my video on Srei Infrastructure Finance. Please like and subscribe my channel, hit the bell icon so that you can get my video straight away when I post it. Thanks a lot for watching.